75 cents by the end of 2025, and some other changes as well. We'll talk about it. Joining me to update us on these moves and where he might be looking to invest next is Starboard Value CEO Jeff Smith here at the New York Stock Exchange. Welcome. Good to see you.
Good to see you too, Sarah.
Just one on the overall environment. Market's been up, excited about the end of the rate hikes, excited about a soft landing. What does that environment mean to you in the way you operate and find targets? Is this a good environment, target rich?
Yeah, I mean, what we want more than anything are healthy markets, and I think we're seeing healthy markets. I mean, you guys talk about it on CNBC all the time. The market and the index is up dramatically, but it's really driven by a subset of stocks that are up a lot, and the rest of the market is a mix. And so from our standpoint as stock pickers, this is a great stock pickers market. When you see companies perform and announce better than expected results, their stocks go up. When you see them disappoint, their stocks go down. Sometimes they go down a good amount and dislocate. Obviously, it's not fun if you own it and it dislocates, but for us, we're opportunistic about that. If we see some stocks, come out with numbers or other announcements that dislocate them to the downside, and we're looking at them, that can be a great opportunity for us. So this type of market is very healthy, and we are looking at many companies that we think could be really attractive.
That you haven't announced yet?
That we haven't announced yet. What we look at, we look for companies that are really good businesses and where we can help them improve mostly on the operations side. So can we get them to perform better, have higher profit margins? And if they're undervalued, underperforming, under-earning, we can create some extra value for shareholders.
So one of those is Algonquin Power, which we don't talk about that much on CNBC, and I believe is also your first foray into utilities. Yeah,
Algonquin is a little different. So normally we're looking at companies where we're going to get them to improve themselves on the operations side. This is a utility. I mean, so utilities are great. Investors who love utilities love investing in those businesses for their yield. And Algonquin's no different. So from where it sits now, if you were to look at it at a high level, it's an over 5% dividend yield, and their peers are at about a 3% dividend yield. So a big difference. And you have to ask yourself, why is that? Why is Algonquin trading so cheap? Actually, they're made up of two businesses. They have a regulated utility and an unregulated utility.
The water business and the renewables?
In the regulated business, there's also an unbelievably valuable water utility, which is unusual. Most power utilities don't have both. So we also think there's extra upside above what we're even talking about if they actually monetize the water utility as well, which we don't think they need to keep. But in general, what's gone on is they've kind of made the traditional utility investors a little more nervous. They went out and tried to do a large acquisition, which actually didn't happen. And their leverage is higher than their peers. And what's changed in the last year plus is that companies that have more leverage or are having cash flow issues are getting punished. This company has more leverage than its peers. So it's not as investable for the traditional utility investors. But the good news is that's easy to fix because those unregulated assets that they own are not really being fully valued. They're somewhat obfuscated in the portfolio. The traditional investors don't really want them, but they're hugely valuable. So we believe they can go out, they can sell the unregulated business, and they can use those proceeds, and they can pay down the debt to around, as you mentioned, around market levels, and then they can actually buy back shares. And if they do that, they can end up with a potentially lower payout ratio than their peers, which makes them really safe, maybe even be able to raise their dividend. And when you look at that, you would say, wow, if that were to happen, do I want to own a better utility? Because their asset mix is actually better than their peers. It's greener, it's cleaner, and it has the water business. So do we want to own a better utility at a 5+% dividend yield versus the peers at a 3+% dividend yield? I would think that people do.